Hello traders, you are welcome back to the Forex Geek channel, and in this particular video we are going to be discussing the liquidity purge and revert strategy. All right, so if you have ever been stopped out of a trade right before the market moved in your original direction, you've probably experienced the liquidity purge. Okay, now this setup is a favorite tactic of institutions and smart money, and in this video we are just going to break down exactly how it works and how you can trade it effectively. All right, let us start with the purge. Okay, a liquidity purge happens when price aggressively pushes above a recent high or below a recent low. Okay, why does this happen? Because those levels are where many retail traders place their stop losses. All right, for example, imagine having a resistance zone around here, and as a retail trader you will most likely sell here and place your stop loss somewhere around here, right? So the smart money will likely push the price up, hit your stop loss, and reverse the market back in your direction. Okay, so they just need to use you for liquidity and move the market in their direction, right? So because those levels are where many retail traders place their stop losses, the smart money try to take advantage of that. For example, above a swing high, you find often, clusters of buy stops. Many traders that are breakout traders will likely set buy stops above a resistance, right? And below a swing low, you likely find clusters of sell stops. So institutions purposely drive price into these areas to trigger those stops. When they do this, they collect the liquidity needed to fill their own larger positions. The purge is usually fast and sharp, designed to catch traders off guard. Most retail traders see this move and assume the breakout is real, but in reality, it's often just a trap. So once the liquidity is taken, price rarely continues in the same direction for long. All right. Now comes the revert. After sweeping liquidity, the market often reverses direction quickly. This reversal signals the true intention of smart money. For example, if price purges above a swing high and then snaps back down, that's the revert phase, right? It's in this moment that opportunities open up for traders who are patient enough to wait. So how do you apply the liquidity purge and revert strategy? The first step is marking liquidity levels. Look for obvious highs and lows where stops are likely sitting. These are your zones of interest. Okay? Areas where stop losses are likely sitting. Identify those areas. Identify those areas, right? The second step is to wait for price to purge these areas. Don't jump in too early. Let the liquidity sweep happen. Okay? Then the third step is confirmation. All right? The third step is confirmation. You watch how price reacts after the purge, like what we can see happen here, right? For example, if price purged upward, you look for a downward reversal. If price purged downward, you look for a reversal upward. Okay? This way you are trading with the smart money rather than against it. Right? Now let's talk about a few tips to master this strategy. First of all, focus on key time frames like the 15 minutes, the 1 hour, and the 4-hour charts. Okay, these time frames often give the clearest purge and revert setups. Secondly, practice patience. All right, the purge can be dramatic and it is easy to get emotional, right? But waiting for confirmation is what separates disciplined traders from impulsive ones. Thirdly, always mark multiple liquidity zones. Okay, the market can target one level, reverse, and then target another, So keep a broader perspective, right? By now, you should have a clear understanding of the liquidity purge and revert strategy. You've learned what a liquidity purge is, how the revert phase works, and the exact steps to trade this setup effectively. You've also gained tips on discipline, patience, and chart marking that will help you refine this approach. Okay? Now let's see if we can find another example of a liquidity purge. Okay? Let's make it at least 2 examples. All right? Okay, so we want to look for preferably, a sell side example, right? Let's see, look for where a liquidity purge happened towards the downside. Okay, if we are going, okay, this is not exactly a perfect example, but you can see that we actually had a similar thing happen here, right? It's not exactly a perfect example, okay, because here, we can just call this a zone, but here we had a rejection, we had rejection here. So price was mostly being rejected within here, but this particular time it dropped below it and quickly reversed upward. But this is not exactly a perfect example, but I'm just trying to show you that this thing actually happens, right? So that's why it's not usually very advisable that you set your stop loss very close to a support for a buy trade, and it's not advisable to set your stop loss very close to a resistance for a sell trade. Okay, if you know that you want to use pending orders, like you want to set this a buy limit, take your stop loss a little bit far away, all right, in case of if a liquidity purge or liquidity sweep happens, right? But the better option is to wait for that sweep to happen, or rather wait for a confirmation that price is about to continue before you jump into the trade. Okay, so if you found this video helpful, make sure to hit the like button, subscribe for more trading strategies and tutorials. Share this with other traders who struggle with false breakouts so that they can understand the power of liquidity setups. Thank you for watching, and I'll see you in the next video. Happy trading.